Let's start off by thinking about the syllabus for P2 and leases. So we have to be able to discuss and apply the accounting treatment for leases by the lessees, including the measurement of the right of use asset and the liability, the circumstances where there may be remeasurement of the lease liability, the reasons behind the separation of the components of a lease contract into lease and non-lease elements, and the accounting for leases by lessors. We also need to look at the recognition exemptions as well. Let's start by thinking about some of the accounting issues associated with the previous standard on lease accounting, IAS 17. The issues were based around three areas: off-balance sheet accounting, understanding risk, and comparability. Now, with off-balance sheet accounting, we need to remember the distinction between finance leases and operating leases under IAS 17. For a finance lease, there would be an asset and a liability on the balance sheet, together with a depreciation and an interest charge going through the income statement. For an operating lease, there would be no asset and no liability on the balance sheet, and just a rental charge going through the income statement. Now, this meant that if you picked up the set of accounts of a company that had significant operating leases, it was very difficult to understand the asset base that the company had and used to generate its returns, because those assets would not be on the balance sheet. Perhaps even more important than that was the fact that the liability associated with those assets was also not on the balance sheet. And this leads us on to our second issue of understanding risk. When we calculate gearing, we look at the amount of debt and the amount of equity and the relationship between the two. But of course, where we have a substantial amount of operating leases under the old standard IAS 17, then the liability would not be including the commitments that exist under those operating leases. And therefore, the gearing would appear much lower compared to an organisation that had finance leases in place. So it would have been very difficult to understand the genuine risk profile of an entity, because a significant amount of its liability was off balance sheet and therefore not included within gearing ratios. And of course, our third problem was that of comparability. It was very difficult to compare two companies, one with operating leases and one with finance leases. And often what would happen is that business analysts would take companies with operating leases, they would want to compare them to companies with finance leases, and the only way they could do this was to artificially create some figures that might exist if the assets under operating lease were in fact under finance lease. Now, that's not a very accurate form of analysis and involved many assumptions. So when we go on to look at the new accounting standard, IFRS 16, we must remember that it's trying to address three main problems: off-balance sheet accounting, understanding risk, and comparability between entities. We'll start by thinking about the scope requirements of IFRS 16, the definition of leases, and why this is important. So IFRS 16 in reality is applicable for accounting periods beginning on or after the 1st of January 2019. And that means that companies that have operating leases are having to decide whether or not those operating leases are within the scope of the new standard. If they are, then we will see assets and liabilities on the balance sheet, and if they are not within scope, then the existing treatment of nothing on the balance sheet and just a rental charge through the income statement can continue. So let's take a look at the definition of a lease to determine which arrangements are within scope. Now, there are three elements to this. The first is that there must be an identified asset. So, for example, if you go on holiday and you were to rent a car, you go on the internet, you book the car, and you book a small family hatchback that might be a Vauxhall, Astra or similar. In other words, there's not an identified asset as part of the arrangement, and therefore that rental would not be within scope. Now, you have to be careful, because even where there is an identified asset, the arrangement may still not be in scope if the lessor has substitution rights. In other words, the lessor is able to swap the asset it's given you for another one. If that's the case, then the arrangement would not be within scope. But those substitution rights, they must be practical, and the lessor must have an economic incentive to make the substitution. The second component of the definition is that the lessee has to obtain the economic benefits. And we say here that the lessee has to obtain substantially all of the economic benefits associated with the asset. Now let's imagine a situation where we are producing cars and we produce complicated car seats with heating and electric reclining mechanisms and so forth. We might outsource the production of these car seats to a third party. Now it could be that we therefore are essentially leasing the production equipment of that third party in order to produce these car seats. But we would look at the level of orders that was going to this third party. And if we were only using 30% of the third party's production capacity, then we don't have access to substantially all of the economic benefit, and this would not be a lease agreement. However, if we were placing substantial orders, such that we were taking closer to 100% of the third party's manufacturing capacity, then we would have substantially all of the economic benefit, and we would, in substance, be leasing the manufacturing equipment of that third party. The third element is that the lessee must be able to direct the use of the asset. And this could involve, for example, imagine a power station setting production levels. The lessee can determine how much electricity is to be produced. The lessee can determine what staffing levels are going to take place. And the lessee can determine the operational procedures that are going to be followed. Where the lessee is unable to control the production levels, the staffing levels, or the operational procedures, because these are controlled in fact by the lessor, then the lessee does not direct the use of the asset, and the asset would not be within scope. Now, from an exam point of view, a good piece of news here. This is all a matter of professional judgment. There's not necessarily a right or wrong answer. So in the exam, if you are debating which assets are within scope, you must consider all the information the examiner has given to you and think about whether that information suggests that there is an identified asset, that the lessee obtains substantially all of the economic benefit, and that the lessee directs the use of the asset. So we've seen the scope requirements and the three attributes that need to be considered. And you can imagine that as this standard was being developed, it was not very popular with entities because it would result in the recognition of rather large liabilities for certain entities, and this would have an impact on their gearing. So as the exposure drafts came out, there was lots and lots of public comment, and ultimately this has resulted in a number of exemptions. And the good news is that if you have a lease agreement with a maximum lease term of 12 months or less, it does not have to be capitalized. It is not within scope. Furthermore, if you have low value assets, these are excluded as well. Now, the indicative level for low value is currently set at $5,000 or less when the asset is new. So if when new the asset has an indicative value of $5,000 or less, it is exempt from the capitalization and thus the scope of IFRS 16. Do take a moment to note that that 5,000 is a fixed figure and it is not set in relation to the materiality of the organization. So this exemption might be valuable to a small organization, but might not actually serve much practical purpose for a larger organization. So do give some thought to materiality. We'll think now about the measurement aspects of the standard, and let's start by looking at the lease liability because this basically forms all of the accounting treatment. In simple terms, we work out the present value of the minimum lease payments. We then set the asset equal to this amount, and thus we have an asset and a liability. So let's look at this in a little more detail. Now, when we're looking at what payments to include in the measurement of the lease liability, we give thought to the following. The lease liability must include any fixed payments, but it must also include variable payments. but it only includes variable payments that are actually based on an indexed rate, such as, for example, the Consumer Price Index. The rationale behind this is that these variable payments are easy to measure because they're based on an indexed rate, and thus they will be included. Other variable payments will be excluded. Also, when thinking about the lease liability, we give due regard to the actual lease term as well, and in a question you may well have to deal with optional periods. For example, a company has a head office. It has it on a 5-year lease, but there's an option to extend for a further 5 years. Now, whether we base the lease term on 5 or 10 years makes a substantial difference to the liability that we're actually measuring, so we must know when to include that optional period. Well, we include the optional period if there is a substantial economic incentive for the lessee to take the additional period. For example, imagine that the rental term within that second 5-year period was so attractive that the company would be foolish not to take it. Or imagine that the building was actually very specialized and had gone through lots of customization. Well, the business is very likely, therefore, to take the 5-year extension. Now, when you read the standard on this, it says consider all the facts and circumstances in making this decision. And in the exam, you must do the same. You must consider all the facts and circumstances and decide whether there is a substantial economic incentive to take the optional period. If there is, include it within the measurement of the lease liability. If there isn't, exclude it from the measurement of the lease liability. Now, another issue that could arise could be to do with lease and non-lease components. Let's imagine, for example, that we were actually leasing an aircraft. Now, when you lease an aircraft, the money that you pay each month does two things. Part of it pays for the actual lease of the asset, but the other part of it could be paying for the servicing of that asset. Now, the servicing itself is not actually a lease, and therefore that is why we have to strip out these non-lease components. And the way that we would strip out the non-lease components would be to allocate payments based upon the relative fair value of the lease and non-lease components. And in a moment I'll show you a simple exercise that demonstrates how we would do this. Now, there is a practical expedient here that says you don't have to split out the non-lease components if you don't want to. So, for example, if you were leasing a head office and part of the lease payments was paying for the security staff that sit downstairs in the foyer, I would imagine that the wages of the security staff were a very unsubstantial amount in relation to the total payment that was being paid each month for the building, and therefore the amount of work that was involved in actually splitting out the wages of those staff would be disproportionate to the benefit gained from the financial reporting. So we really are only looking to split out non-lease components where the non-lease element is a substantial component. But again, it's a matter of professional judgment. I'll show you this with numbers in a second. Also, when calculating the lease liability, I mentioned that we calculate the present value of the lease payments, which implies we have to use a discount rate. Now, of course, in the exam, we may be told that the interest rate implicit in the lease agreement is, say, 5%. However, in reality, we may not have this information. And if it is difficult to ascertain the interest rate implicit in the lease, then we are, again, as a simplification to the process, allowed to use the entity's incremental borrowing rate. So if you're ever doing a question and they don't tell you what the interest rate implicit in the lease is, but they do tell you at what rate the company can borrow money, then that is the rate that we use when measuring the lease liability. So here's some numbers then to demonstrate the concept of lease and non-lease components. Imagine an arrangement where the total payments under the lease agreement in present value terms came to £600,000. And this was a lease agreement where we're leasing a product and also we're getting that product serviced as well. So some of the 600,000 relates to the actual leasing of the product and some of the 600,000 relates to the actual servicing. And of course the servicing is the non-lease component, and so we might consider splitting out the amount of payments that relate to the non-lease component. Now, in order to do this, we need to find some market-based evidence of the standalone prices of leasing the product and the standalone prices of servicing the product. So let's imagine then that what we see is that the standalone price of leasing the product is £34,500 per annum, and the standalone price of servicing the product is £2,000 per annum. Now that would give a total of £36,500, and what we can just see here from the numbers is that the leasing of the product accounts for 95% of that total, and the servicing of the product accounts for 5% of that total. Therefore, of the 600,000, 95% of that is for leasing the product and 5% of it is for servicing the product. So, in terms of lease accounting, we would take the 600,000, multiply it by 95%, and we could just include 570,000 when we are measuring our lease liabilities. The remaining 30,000 would be treated as expense in the normal way. Now do remember, this is optional. You don't have to split out the non-lease component. It is a choice. Read the question carefully, see what the examiner wants you to do, and remember that the choice exists to give you a practical expedient where the servicing element is a non-substantial part of the overall cost, and therefore splitting it out does not add value to the financial statements. So once we've calculated the liability side of things, we're in a position to calculate the right of use asset. And you can see here that the right of use asset is basically the present value of the lease payments that we've just calculated. However, in addition to this lease liability, we would, on top of this for the right of use asset, also include any initial direct costs, any prepaid lease payments, any estimated costs to dismantle, and we would take off any lease incentives received, and this would give us our right of use asset. Now in a few moments I'll show you some numerical examples and we can see just how the right of use asset is calculated. So we've discussed the calculation of the liability, we've discussed the calculation of the asset. Let's pull this together now and demonstrate with a numerical example. And what we can see here is a lease agreement where there are annual payments of £150,000 per annum. And these payments are made in advance. It's a 5-year lease agreement. And let's pretend we were told that the interest rate implicit in the lease was 5%. So the first task would be to work out the present value of those minimum lease payments. And we can see that the payment for year 1 is made in advance, so it isn't discounted, but the others are just discounted using a 5% discount factor calculated in the normal way. And when we have a look at the present value of the minimum lease payments, we can see that in total they come to £681,893. So this forms the basis of our calculation. Now, the opening liability then is the 681,893, but don't forget that we've already made that payment in advance of 150,000, and therefore the opening lease liability is 531,893. Now what we have to do is to calculate the right of use asset, and the right of use asset is basically the lease liability. We've just calculated the lease liability at 531,893. And on top of that, we add any prepaid lease payments. For example, that 150,000 that was paid in advance. And therefore, this gives us a right of use asset at 681,893. So we now have our right of use asset and we have our opening lease liability. Now, turning our attention to the income statement then, as we go throughout the year, we have to charge interest on the liability and we have to depreciate the right of use asset. So the right of use asset then that started at 681,893 is being written off over 5 years. So that would give us depreciation of 136,379 in the first year, and therefore at the end of that first year we have a closing right of use asset at 545,514. On the liability side of things, we take our opening liability of 531,893 and we apply the technique of amortized cost. So, applying 5% to the opening liability gives us an interest charge of 26,595. That interest charge would of course go through the income statement, and a closing liability, therefore, of 558,487. So we now have our year-end position on both the asset and the liability. Now let's imagine that we move into year 2 of the agreement. And in this particular agreement, we see that the payments are based on a consumer price index, and that consumer price index has increased by 3%. And therefore, rather than the payments of $150,000 that we had last year, we now have payments going forward of $154,500. And we have 4 years left to run. So let's work out the present value of those new revised payments. Our year 2 payment is being paid immediately, so no need to discount that, but the remaining 3 payments, of course, would be discounted. And therefore, this takes us to a revised liability of $575,242. Compared against the existing liability of $558,487, we see an increase of $16,755. Now, the double entry to account for this increase in liability is nice and straightforward. We simply increase the liability with a credit, and there's an equal and opposite increase to the right of use asset with a debit.